Okay, I think we can get started here. So welcome everyone. Today's webinar, we're talking about STOs, ICOs, digital security offerings, how they differ, who's regulating them, who's using them, who's investing in them, sort of all the different topics that are often misunderstood within our industry. So today we have Darren Marble, the founder and CEO of Issuance, and Oscar Joffrey, the founder and CEO of KoreConX. I'm Emily Cornelius. I'm the Director of Marketing here at KoreConX. So I will pass it over to, we'll start with Darren just to introduce himself before we get started.
Thanks, Emily. It's such a pleasure to be on with you and Oscar today. I appreciate you guys having me on. I'm Darren Marble. I am the co-founder and CEO of Issuance. We are developing a private placement and capital formation platform for both digital and traditional securities. We are based in sunny Southern California in Los Angeles. Prior to Issuance, I was the co-founder and CEO of CrowdFundX, a financial marketing firm also based in LA. And we spent a number of years marketing Regulation A+ IPOs to NASDAQ, the New York Stock Exchange, and OTC Markets Group.
Wonderful. And Oscar, do you want to go ahead and introduce yourself?
Wow, did you say sunny California? I mean, that was a stab for us here in the East Coast. So from east to west, here we are. Yes, Oscar Joffrey. I'm one of the co-founders of KoreConX. So we provide an all-in-one business platform to help companies for the issuance and management of their digital and traditional securities, to make sure that it manages the entire life cycle of those securities, and as well all the other securities that you're issuing, and bringing all your stakeholders together, meaning your board of directors, shareholders, legal counsel, advisors, and people like Darren Marble at issuance.com to help you with your capital raise. So looking forward to today, because we have this topic is probably dear to me as it is to Darren. We've had our challenges the last little while, and looking to kick this thing off. Let's go, Emily.
Wonderful. Okay, so without further ado, we'll jump right into it. I want to start at the beginning, sort of how did we get here? From obviously traditional securities to ICOs to STOs to, I mean, there's a whole bunch of different acronyms being thrown out there. It seems like a new one comes up every day. So why don't you start off by just giving us a quick, how did we get here?
Well, Darren, you want to go first? You want to go at it?
Sure. I mean, look, the ICO was an innovative capital raising tool for entrepreneurs to access investors online. And the challenge that we've had with ICOs is that they've largely been unregulated on a global basis. And as we've seen, unregulated markets drive a lot of bad actors into the industry. And unfortunately, we've seen a lot of investors, retail investors specifically, lose money investing in ICOs. I think everyone on this webinar probably knows an ICO stands for initial coin offering, and investors are buying tokens that in theory provide them access to some future system or platform. And it's really a speculative investment. Those tokens don't have any tie to the underlying assets. So it's non-dilutive capital, which of course is massively attractive to entrepreneurs, but was really mostly used as a speculative tool for investors. The basic play was simply to buy up tokens at the earliest rounds and then to immediately sell or dump those tokens once they were listed on some secondary exchange, a decentralized exchange. And now we've kind of moved into a new phase of regulated token offerings. But Oscar, do you have any comments on ICOs? I know you and I both have strong opinions about this.
And I do, and I'm never afraid to share them, because you and I have been through this for, I don't mind telling people when this really started. In my books, it started way back in 2010, 2011. This is all about democratizing capital, and this is just an iteration of it. And the first iteration was crowdfunding. And Darren was one of the most successful companies with CrowdFundX utilizing that those kind of new ways of raising capital. helping companies like Elio and others to raise their capital successfully. And yes, of course, through that, people started adding technology. That became the essence of how we could make it more efficient. Tokenization to me it is the holy grail. I do believe that blockchain itself, it is the major disruptor in private capital markets. But unfortunately, it felt like everybody looked at the shiny light bulb and put all the rules aside. And it's regrettable because there were some really legitimate companies, as Darren iterated to. There were some really good companies with great intentions. But when you look at the market, 78% were fraud. It's kind of hard to kind of say, you know what, that's a working model that we can move forward with. So that being said, I believe that this is just another step that we move that notion where we started way back 9 years ago, democratizing capital. That's my theme that I've carried all these years. And I find it ironic that all the people within the crowdfunding sector, which Darren, you know, we work with all these different people around the world. There's an infrastructure already ready there for this. So yeah, it's my view is that ICO kind of lit it up. It's unfortunate what happened, and so on. Now we're going back to how do we bring those two things together that are going to make the difference going forward.
Okay, great. So who would be using, say, an ICO versus a DSO versus an STO, or are people still using ICOs? Just before we sort of get into digital securities here, are people still using ICOs and STOs compliantly, I guess, is the key question there?
Well, I mean, I just read it. I don't know if Darren saw this. I'll let Darren go after it, but I just saw a release from the SEC that in the first quarter, there were 33 ICOs that were not compliant. So at the end of the day, people are just not getting it. And let me be very clear. ICOs are illegal. You can't slice it and dice it any other way. They're just illegal. And people say, well, if I go to this jurisdiction, it becomes legal. No, it does not. And that's just whoever's giving you that advice is giving you very bad advice, because ultimately you will land yourself into problem with regulators. So in my view, ICOs are finished. And for those who continue to do it or find ways around it, all are really trying to skirt the law. So you really have to question them, in my view. What are you trying to accomplish? Right?
Yeah, look, I agree. I think, look, generally speaking, the people who ran ICOs were opportunists. They saw an opportunity to make a quick buck. And we've seen an infinite number of stories of cash grabs or crypto grabs where fledgling entrepreneurs, you know, with a white paper and nothing more than a concept, raised millions or tens of millions of dollars and disappeared, and never developed a product, never launched a platform, and left investors holding the bag and losing 90 to 100% of their investment. And that's simply not sustainable. Were there good entrepreneurs out there? Sure. Were there well-intentioned teams? No doubt. But unfortunately, that was the minority of ICO entrepreneurs. And look, if you were thinking about doing that today, I think the opportunity's passed. The quick money was made. The time to do an ICO was a year ago or 2 years ago. So we've really moved out of that phase. It has already wound down. I think it's old news. I don't think this should surprise anyone. And now we're kind of in this dawn of a new era, the era of digital securities, which we believe is the next mega trend in capital markets. Although I do think it is going to take time, many years, a decade or more, for this vision of digital securities to truly be realized. And you mentioned, Oscar, at the outset, and Emily as well, there's all these new terms, you know, security tokens and digital securities. My own opinion here is that the word token has been tainted. It's been tainted by the ICO market. And I think that most people, when they hear the word token, consciously or subconsciously, what they actually hear is scam, fraud, theft, or hacking. And so while security token was a term that was used widely a year ago, I think digital securities are probably the better term to represent digital assets that are compliant with federal securities laws and run on a blockchain. That's what a digital security is. And I think, the word token is just a bad word, unfortunately. And what's ironic is that most people in the industry don't see that. They're too ingrained. They've drank into Kool-Aid. And I think if you were to say that word, even crypto, to somebody outside of the industry, it has a real negative connotation. So I'm a proponent of the term digital securities. And this is kind of the thesis, as you can see here. And this thesis has been stated over and over again by advocates. And so what I wanted to do is kind of share the thesis versus what we're seeing on the issuance side is kind of the reality of the market. What's actually happening? Are deals actually getting funded? Who's actually raising capital? And what are some of the challenges that are preventing entrepreneurs from being successful? This is kind of, actually, maybe if you can go back a slide just to highlight the idea of digital securities. I think the basic thesis here is that you can tokenize equity and debt in a business, and then you can trade those digital securities on a secondary trading venue, an ATS or an exchange. And so that is, essentially inspired from the ICO era, and in a lot of ways was promoted as the biggest driver for why digital securities are going to be this, new and emerging market. The idea that you can take a private company and make it liquid and make the securities in that company liquid. And that's attractive to any small business owner, to any entrepreneur, as well as to investors. The idea that you don't have to be locked up for 5 years or 10 years and hope that the company goes public or hope the company gets acquired. The idea that you can trade these digital securities 24/7, the idea that you can fractionalize assets. You could break a commercial building in Toronto into 1,000 units or 10,000 units and allow retail investors to own a small piece of a large asset. This was the thesis. And I think that the reality is not there yet. So if we want to go to the next slide, I think at the moment that most issuers that are attempting to raise capital through a digital securities offering are struggling or failing. And that probably shouldn't surprise you, because this is a new type of capital raising mechanism that strives to be compliant with federal securities laws. So, one of the upsides to running an ICO is that you don't have to follow securities laws, and therefore you can bypass a lot of requirements that generally take time, effort, and money to follow the rules. So when you're following the rules, there's a process in place, and that process involves securities attorneys or auditors or advisors and certain, know your customer and anti-money laundering laws that Oscar and team are familiar with. But most deals, I think, are struggling to fund. And what we're seeing is that there is a surplus of what we call early stage deals. And Oscar, you've seen this as well in the equity crowdfunding space, whether it's regulation crowdfunding, also known as Reg CF or Reg A+. When those securities exemptions were rolled out in June 2015 and May 2016, it naturally attracted companies that were otherwise struggling to raise capital. And so one of the issues that I think this industry is seeing is just adverse selection, which is you do have a lot of distressed startups thinking that this is a quick path to cash, that somehow there's a trick here, and maybe if they costume their startup as a digital securities offering, that they're going to raise millions of dollars. And I just don't think that's true. So there's a lot of early stage deals. There are a limited number of high quality offerings, and yet there are an increasing number of them as well, which I think is probably the most exciting aspect of this industry, is that there are established companies, publicly traded companies here in the US that are now pioneering capital markets and consciously choosing to run a digital securities offering. And maybe, to touch on liquidity, there's very little liquidity today for the handful of digital securities that are actually trading on platforms like T0 and Open Finance, Blockchain Capital, BCAP, Spice VC. There's a handful of these digital securities that have raised capital listed to these platforms, but there's very little liquidity or trading today. And again, that shouldn't be surprising either. This is a brand new market, and I think it's going to take time to develop. Oscar, what are you seeing on your end?
Well, I agree. I mean, I think we're now once again trying to re-educate the market again. I mean, the ICOs hurt everybody globally. The billions of dollars that either retail investors, family offices, and institutions have lost is being felt globally. And I do believe that if a company is approaching the market with the word token, or even if they can get the investor to go with it, now you got the regulators to go with it. It's a major red flag. So from those perspectives, the thesis for digital securities is dead on. We need to bring the differentiation, and now we need to bring education. So we're in an education path, you and I, and many others. It's not just you. There's an entire ecosystem of providers, lawyers, issuance platforms, broker dealers, marketing firms, and so on. But as far as the market itself, how long will it take? One advantage I think we are from the days when crowdfunding got started is that during the crowdfunding era, we needed to figure out so many different things that it took years. You're right, it took years for things to unfold. I think this time we're going to expedite it faster. There is one drawback that I do see though, and that is that the first comers to the market saw the shiny light and got all over it without asking any questions about how this will operate with current securities laws. And so when we approached the market with our particular solution, we had to look at current regulations globally and how are the regulators going to react and how do you move it forward. And the only way you can move it forward, back to what Darren was saying, to get liquidity, momentum, and getting small deals, good deals, and all that finance, you've got to get the entire infrastructure that's already there on board. Not just one or twos. One or twos isn't going to make it. It's not just going to be one company raising capital. No, unless we get all the people that are managing capital for different types of investors, whether the family offices or institutional, into these chains. And then of course we got to get the service providers and all that to bring the efficiencies. It will take years. I do agree with that. That is our goal right now as KoreConX, is bringing the infrastructure in. That the industry needs infrastructure, an infrastructure that it can trust, and an infrastructure that meets regulatory requirements. And right now there are lots of opportunities, and for us, KoreConX is not a broker dealer, so we often send them over to people like issuance.com or others in our ecosystem to be able to speak to them. And we hear the same thing, which is they're not ready. They haven't come prepared. They think it's just put it out there and people will come and put money in. It's not that simple anymore. So education, we're back to that. One, bringing trust back with the investors. I think it's the biggest one we got to deal with. I think that's the one that probably is holding most of it back, because now we got to educate them. Okay, you're not a token, great, but you're talking digital securities on blockchain. Last time I heard about blockchain is that I can get my wallet hacked or somebody can steal from me. I heard about this, exchange that. So now you got to educate them completely on where is this thing sitting on. And what happens, the what if? What happens if you're not there anymore? What's going to happen to me? And those are the kind of questions corporations that are actually legitimately thinking about putting their securities on blockchain are asking, that nobody asked during the other phases of tokenization, as others would, it was anybody with an idea on a napkin and boom, voila. So I do believe the momentum now is on infrastructure, and infrastructure has to be with the current stakeholders that are in place today. I do not believe that you can shake the tree because you got a shiny light and the regulators are just going to adhere to and change what took 10 years, in some countries a lifetime to change, and all of a sudden it's just going to happen magically because this technology you have is going to meet all the requirements, and yet all you've shown is fraudulent activities. So one, education. Two, companies need to be better prepared. They need to have the right advisors. We're back to that. Yes. Is it costly? Well, depends. It's only costly if you are not prepared to take the responsibility of being an entrepreneur and running a business that's going to have you shareholders. If you're not ready for that, then you're not ready for this type of capital raising. But if you are, there's a road ahead, and there's companies out there to assist you. And when that market occurs, it will be there. Liquidity, I couldn't disagree more with that, Darren's point. There is no liquidity going on right now. Look, if there was liquidity, it would have been before tokenization. It would have been with accredited investors, companies like SharePost, which was purely for the ultra high net worth. Trades of $250,000 or more. That's not liquidity. That's not the masses. But we do have the instrument. We do have the exemption in the United States today that allows us to give that liquidity, but we got to get the infrastructure laid out first. We got to get the platforms like Open Finance and others to make sure that their systems are in place to be able to handle a $10 trade. Because we have it on the primary capital raise, where you can go to Republic today or Start Engine and platforms like those. They're helping the companies raise millions of dollars at $50 or $100. Now those securities can trade, but there's really no secondary market. So you need to bring both the accredited and the non-accredited. And then, of course, as David Weil says, if we can't bring the money that's sitting in asset managers and investment bankers downward to trade with it, liquidity will never happen. But it all comes down to the letter T, trust. And that journey doesn't happen overnight. Darren said it best, it can take years, if not a decade, to build it up.
Right. So
yeah, look, I was just going to make a comment. Again, regarding secondary liquidity, I wanted to share this. This was actually feedback that we got from a well-established family office in New York. We are advising a tokenized venture capital fund, also based in New York. And part of the pitch that this tokenized fund was using was to promote the idea that they could make their LPs, their limited partners, liquid. So rather than a limited partner investing and then waiting 7 to 10 years to see a return, the idea that their investment could be made liquid, tokenized, and then they could trade out on their position within a year. This was the feedback we got from the family office. It was actually used as an objection to pass on the deal. They said, well, hey, our steering committee looked at this, and what we determined is that the notion of secondary liquidity makes this interesting as a future investment rather than an opportunity for a quick exit. And so they decided to pass on investing in the tokenized venture fund. They said, go raise your capital, go list your digital securities to a secondary trading venue. And once you have a NAV, once you provide regular disclosure, then we may purchase your digital securities on the secondary market. And so it's just a cautionary tale for digital securities issuers that are overly promoting this idea of liquidity because it doesn't truly exist yet. It could be used as an objection. So my recommendation is to include it, but not to overly promote it because, again, in this case, a very savvy investor used that idea as an objection to pass and kind of said, hey, we'd prefer to wait and watch what happens and then buy your digital securities once it's trading. So it's just a word of caution.
It's going to happen from different points of views, right? Everybody's gonna, but it is a good point. I like it though. A lot of the companies, the real emphasis on digital securities, trading, and what we're saying right now, it's not happening right now. We want it to happen, but if the infrastructure isn't there, it's just not going to happen.
Do you guys think it's?
If you can go to the next slide.
Oh, sorry. This one.
Yeah, I kind of wanted just to point this out. I think it's really important for people watching. This is what we're seeing in the market, and Oscar talked about it, which is that there's an infrastructure being built. Okay, so the train is running down the tracks, and you've got companies like KoreConX and Issuance and others that are laying the railroad in real time. What we are seeing right now is that most of the investor demand for digital securities is into infrastructure companies. And let me quickly define infrastructure because it's a broad term and you've heard it used a few times in the last few minutes. When I think of infrastructure, what I think of is primary issuance platforms, companies that help issuers to create and issue digital securities, okay? When you tokenize the capital stack, the equity and debt in your business. I think of compliance platforms. I think of capital raising and deal marketing platforms and secondary trading venues, T0, Open Finance, Templum, etc. That is what infrastructure is, and I put it in the bullseye because most investors in this industry are looking to invest in infrastructure type businesses. You hear about and you see a lot of announcements for tokenized real estate deals. So I put that in the blue, and that's right outside the bullseye. The question I think that a lot of us have is how many of those deals are actually getting funded? And what's tricky about new industries is that there's not a lot of hard data to back up the idea that any of these deals are getting funded. It's a little bit of tribal knowledge. You know, I have a call with Oscar, he has a call with another company. You know, the infrastructure companies are sharing information, issuers are sharing information, investors are communicating, but there's no Deloitte and Touche study that's going to tell you, 1,000 companies went down this path and 281 succeeded and the average raise was 12.3 million. It's completely non-visible right now. My sense is that most of the tokenized real estate deals are not funding. And I think there's different reasons for that. I think one of the challenges is that you've got tokenized real estate or even tokenized VC that are pitching digital asset investors. And some of these digital asset investors are kind of carried over from the ICO days, they're known as crypto hedge funds. My opinion is that if you are going to do a tokenized real estate fund, you should be pitching traditional real estate investors. Traditional real estate investors. If you're doing a tokenized venture capital fund, you should be pitching traditional LPs. And if you can't convince a traditional institutional investor or a traditional limited partner to invest, then that's an issue for you as an issuer, and it's an issue for the industry as a whole. Because I think what needs to happen more than anything else is that traditional investors need to buy into the value proposition, right? On that earlier slide, that's the key to the growth of this industry. It's not 100 issuers raising their hand and saying we want to raise capital. It's the ability for those companies, for your company, to convince a traditional investor that there's value for them in investing in digital securities. So I think it's a mismatch when you have these new companies that are real estate or VC. They're trying to do a tokenized version of a traditional asset, but they're pitching non-traditional investors. That to me is a mismatch. And then just to make it laser clear here, you'll see other is outside the circle. If you are not an infrastructure company, if you're not a real estate deal or tokenized venture capital, I think there's high risk of failure. And it doesn't mean you'll fail. It just means that you're going to have to push really hard to find the right investors, because I'm seeing that there's limited demand, not zero demand, but there's limited demand for traditional businesses that are just tokenizing something. And we've got a client that's doing this in the biotech space, which I can speak to in a moment. But Oscar, you guys are obviously on the receiving end of tons of deal flow as well. You're probably busier than we are. What are you guys seeing? Do you agree with this chart? What's your opinion?
As far as the infrastructure, 100%. The only way we move this thing forward if either companies like yours, Issuance, the ATS operators, and let's not forget the transfer agents and everybody else involved in the capital raise activity, are on board and are using these technologies for the efficiencies. Because let me give you an example. Just because the issuance platform could be efficient, the secondary is not, then we're back to square one again. So it is at the infrastructure level. Regarding real estate and traditional assets and VCs, the way they're approaching the market, I obviously have my views as to why I think the early adopters or crypto hedge funds or whatever you want to call them. I think they went in the first time around with, hey, let's get into that shiny light, and they put it in and got some out. They're getting smarter now. They're starting to ask the right questions. They're understanding now that if this thing is a security, maybe what you're giving me right now isn't a security, and this thing is going to fall apart before it starts. We've obviously seen a few deals fall apart in real estate because of that. But I do agree with the thesis that those companies are going after the wrong type of investor. I mean, look, here's
Oscar, I think we lost you there.
Can you still hear me, Emily?
I can hear you, Darren. Yeah, Oscar, I think you just muted.
Okay.
Darren, while Oscar's figuring that out, so as far as education, and you mentioned it could be 10 years before digital security offerings are sort of accepted in the common marketplace.
Doing our digital.
There we go.
Oh.
You're back.
Sorry, sorry. I was saying that the as far as real estate is concerned, right? I apologize for that. You guys got the part about real estate a little bit?
No, start from
some of it. No.
Oh, wow. I'm gonna have to talk to Go Webinar once again. Hey, look at that. There's a blip in the look. What I was trying to get at is infrastructure is the key right now. That's one. They're laying out the pipes, making sure all the pipes are working together seamlessly to remove the inefficiencies, because that's really what blockchain is doing. For anybody who spent any amount of time, and no, Darren's been there for over a decade or more, like me. Here's my gray hair to prove it. In this space, it's not that simple. It's not just KYC AD verification. You forgot all the back office stuff. So I personally see, yes, 100%. That's one. Number two, going after the real estate, there are many reasons why these investors are not going back in. They're asking the right questions now. They're asking, hey, is this the right chain? Are we going to be in trouble? And that's one. But I think the bigger problem is Darren nailed it. They're going after the wrong type of investor. I mean, look, the report by E&Y and PwC, 78% of all crypto and token holders are developers, software developers, which is great, but they're not the real estate investors. They're not the venture capital investors. So going after that type of investor is critical. And when we started our capital raise, thank goodness we never took this advice. We were told that we needed a crypto leading investor to lead us on. And we said, no, we want the traditional guy to see the opportunity, how this is changing their world. We want to empower that ecosystem that's there. I'm not trying to displace them. I'm trying to say, hey, you got a license. Here's an opportunity that you're not seeing that you should adapt. So now we're seeing tremendous amount of deal flow, but an interesting thing that's happening to us as of late, and it's, we're now seeing larger companies. Now, we're not a broker dealer. Whether a company raises $1 million or 10,000 or $1 billion is irrelevant to KoreConX as an infrastructure. But it's interesting that most of the companies coming to us now are doing large $100 million funds, right? In particular industries that are very traditional. These are very serious corporate companies, not startups. So they're putting the effort, and they got their legal counsel, their auditors, they got everybody lined up. So the only thing they want is assurances that what they're about to undertake is not going to land them in any kind of problems with regulators. That's really what people want to hear. But I do agree with the thesis here with the demand from investors, and this should not discourage any company from not looking at doing your digital securities. We're just saying that it presented to the investor you would normally go to, and if they buy in, you start getting a buy-in all the way around.
That's right. And probably also worth mentioning, because we didn't touch on it yet, what are the tools, or what are the right exemptions to use to raise capital, and how do you stay compliant? It's actually quite simple. You should use Regulation D 506C. So it's a traditional private placement that allows you to generally solicit or market the deal. And the beauty of that exemption, along with regulation crowdfunding, Reg CF, or Regulation A+, Reg A+, the common denominator in those three exemptions is that you as the issuer have the ability to market your deal. And therefore, it's a question of, how well do you market your investment, and can you target the right investors with the right message? But that is the opportunity. My personal opinion is that Reg D makes sense for 95% of companies looking to do a digital securities offering. It's fast, easy, and efficient, and it's a tried and proven strategy to raise capital. The downside is that you're limited to verified, accredited investors. So it's not a play for retail. You cannot take in capital from non-accredited. However, it is cheap, it is easy, and there are almost an infinite number of funds, family offices, VCs, high net worth that you can raise capital from. And in some ways, it's the simplest way. So most of the companies that we're working with in this space that are running digital securities offerings are using the Reg D exemption because of those reasons. However, there are a handful of companies that have gone down the path of Reg A+, which requires that you submit a Form 1A offering circular to the SEC. That requires a securities attorney. It requires an audit firm to be engaged and provide 2 years of audited financials, and it requires SEC qualification. No company to date that has filed for a Reg A+ digital securities offering has been qualified yet by the SEC. They've spent hundreds of thousands of dollars, attempting, because it is a costly process and it's been time consuming, but it hasn't happened yet. I estimate that at some point in the next 3-4 months, we will see the first companies that are doing Reg A+ get qualified. And my only comment on Reg A+, having done a number of deals in the space, is that it's not a good fit if you're a pre-product. It's not a good fit if you're pre-revenue. And it's not a good fit if you don't have paying customers. So even if you have the $250,000 or $500,000 that it's going to cost invariably to engage an audit firm, a legal services provider, and a marketing partner, unless you have an established company with a large customer base, your chances of failure are high, even if you get qualified. So just be cautious that Reg A discriminates and it favors established companies that have consumer products, and it's very challenging for companies outside of that description to effectively raise capital from the crowd or masses. So generally speaking, Reg D is probably the fastest, easiest way to run a digital securities offering.
Well, that's interesting. I share that comment. The advantage we've had at KoreConX is that we have a number of Reg A+ companies that, oddly enough, they come to us after their offering, and of course we do a book entry. There are no physical certificates, and of course they get digitized. And I think there's a nuance there that people have not understood yet, hence the reason why the SEC is holding back a lot of them. Now that we've had our chats with them, they're asking the right questions. You're issuing this security, and there's going to be a wallet involved. There's a 51% attack involved. There's all these other things. When you go with us at KoreConX, all those things are removed. But here's something I got to ask you, Darren, because I do agree with you, but I've seen something really interesting, and I don't know why it's being made possible. I wasn't part of their offering or anything like that. Obviously, because they're on our platform, they're our clients. We provide them transfer agent services for Reg A+ clients who remain private. But I've had a couple biotech deals that have actually done, not big raises, but they have no product or anything like that, and they were able to succeed on raising, fair good chunk of money to be able to proceed. And is that because maybe they're changing their messaging that's attracting that retail investor, do you think?
Yeah, look, it comes down to the mix of investors. So, look, if you have a biotech company that raises capital under Reg A, I guarantee you that 90% or more of that capital came from high net worth investors, family offices, probably more than that. And yet you've got these biotech companies that I think desire to allow everyday Americans or people over 18 globally to participate. And the one advantage that a biotech company has is that there is a story. And what we've seen with Reg A is that companies that tell effective emotional stories are more successful at inspiring retail investors to come into the deal and participate.
Yes.
We've worked with biotech, we've worked with medtech and Reg A, and so storytelling, visual storytelling through the video, the campaign page, actually becomes an important tactic to create awareness and really to inspire people. So biotech companies that have a message, that are trying to cure some disease, there's maybe an incentive there to look at Reg A+.
No, that's yeah. I was curious because I've only seen a few, but I do agree with you. I mean, the most successful client we have is a retail client with just under 250,000 private investors, and and that's a lot of people to be. But their success is because their shareholders are actually customers, right? That's the key. And
that's right.
As soon as you do that, I think that's a winning combination. Personally, you know, until I got a better understanding watching you do Elio successfully. I mean, I remember the first webinar I watched of you, how getting the crowd involved. And why this is important, I think, why we're talking about Reg A+, because I think people don't realize that if we can break the barrier, that if we can make Reg A+, not just for the consumer driven, but also business, we can start bringing in that type of investor, because and if we can get secondary market trading platform to be able to facilitate their trades, because here's the holy grail of that exemption: upon closing of the offering, those securities become free and clear for trading. That's it. They can trade immediately. And so right now there is no venue for them other than being listed, and most of these companies want to remain private. As their TA, I have to do it for them. But
right.
The point is that we put this on an Open Finance or AX Trading or Rialto Trading, any of these secondary market platforms, we will have volume. That's one.
Right.
And then we can start bringing substance, because it's a mixture of two. So I was adding the other day, if we brought in all our Reg A+ clients to a secondary market, I mean, right there, they're bringing in just over 200,000 investors, like right there. I mean, that's a huge amount of upload. Now, yes, they only bought $100 or $200, but here's what we see as a company. As a company, we see that when a company closes its offering and we're the transfer agent, they keep asking, hey, can we buy more shares in the company? Because I know the deal's closed. Do you know where I can buy them? It's so frustrating to let them know that, I'm sorry, you got to contact the company, and the company's stuck because it's not able to do anything. So, and it's really interesting. But I do agree with you. I think this is part of the evolution. And for those listening in today, I'm a big advocate that Reg A+ is the holy grail to a certain degree for anybody doing digital securities and promising the land of secondary market trading. Because as Darren said, anybody over the age of 18 globally, and it's a non-accredited exemption. So there's no excuse for anybody to say that nobody has that exemption. The United States has it today live.
Yeah, that's correct. Maybe we can just do one more slide, Emily. I want to talk about this biotech company we're working with when we're on that note, and then we can open it up for questions if you'd like. This is a client we're working with. It's called Agenus. They're based in Boston, Massachusetts, and these guys are pioneering the industry. They are the first publicly traded company in the United States to run a digital securities offering. And what inspired their CEO, Garo Arman, to go down this path is that this is a company that develops innovative immuno-oncology cancer treatments. That means they're developing cancer drugs that use the immune system to fight cancer. This company has been publicly traded on NASDAQ for more than a decade. It's a $400 million market cap business, so it's a decent sized, respectable company with a track record. And they have 16 cancer treatment drugs in development. And so we talked about this idea earlier of fractionalization. And that's really what motivated the CEO here. They are raising capital for their leading cancer treatment drug. So they're taking one of those 16 drugs and essentially tokenizing it and allowing investors to make a bet that if that drug receives FDA approval, they will receive a substantial multiple return on their investment, 5 to 7 times their principal investment if that drug receives FDA approval. The alternative for companies like this today is royalty financing, so which has a lot of downside actually. Traditionally, royalty financing deals for biotech companies involve an investor making an investment, and then they receive a percent of future sales in perpetuity. They get paid forever, and that's not favorable to the company or the issuer. So what's most interesting about this deal is that, again, if you refer to the last slide, it falls out of the category. It's not infrastructure, it's not real estate, it's not tokenization, it's not VC. Therefore, it is a challenging deal to raise capital for. And what Agenus is finding is that the most interested investors are not crypto hedge funds, they're not digital asset funds who, by the way, know nothing about molecules and would never figure out the science of this business. It's actually with their existing institutional investors who already own shares of the NASDAQ common stock. That is the opportunity for this company, and it may be the opportunity for your company as well. If you are an established publicly traded company, if you are an established privately held company, I challenge you, if you decide to go down this path, your opportunity is to sell the investment to existing investors or investors in your network, not these digital asset funds that are more cryptocurrency or blockchain focused. So this deal is in process. Their goal is to raise $50 to $100 million, and they're actively talking with existing investors to see if they can get them on board.
That's a great story. I love it. I read about it. It's good to see that you're behind that. But that is interesting. Something that you've mentioned. Not only is it a bonus for the people buying in, but it's also a great bonus for them as a company. Is another alternative rather than the traditional high-end, high-yield, royalty stream that often that's their only choice. Now, if they can just make sure that the digital security they're presenting to that institution meets their regulatory requirement, because that's usually where I'm seeing the other side of it as well, Darren. I'm seeing companies that they've raised their capital, they've done all the right things. I mean, we have a company that we're about to announce called Mint Health. Great. You would categorize it as in the biotech space. They did their offering successfully and all that. Now they need to issue their digital securities, and that's where so it wasn't so much that they weren't able to raise it, they got it. Now they got to deal with the issue that the security itself is not compliant with SEC rules. And so that's another thing that people need to consider. And it's not, one, it's obviously the offering you got. Two, is it going to be compliant? And really do your homework. Your lawyers are the only ones that will make sure of that, because trust me, you don't want to get a cease and desist letter from the SEC or have issues when you've been issuing securities under Reg CF and Reg D, and all of a sudden, wow, how do you issue a security to these people and one can trade, the other one can't? All these different elements. So I love this deal. I'm glad to see you working on it. It shows you've always been in the you're always on the front lines of all the good deals.
We try to be. We try to work with best-in-class companies.
Oh, perfect. Sorry, Emily, you were going to say?
No, just before we get into questions and answers, because there is a few questions that were emailed in before and have come in during. Do you guys quickly just want to go over, obviously there's a lot of things that need to happen for this to get sort of mass adoption. We need, infrastructure to be grown out a little bit more, connections into secondary markets, things like that. I guess the retail investors need to be educated more, and probably the regulators as well, on sort of decoupling blockchain from crypto and things like that. There's also, do you think that's the biggest change, or do you think there will be changes in the actual regulation going forward, or do you think the industry itself will grow under the current regulation?
In my view, I'll start. In my view, I think the industry is evolving, and Darren started it. I remember, I don't remember the date. I've been looking for your posting. So Darren put something up, and he does it once in a while. He put something controversial for a discussion, and it obviously stirs people's emotions. And I remember responding. I really didn't know which one it was. All I cared about was that it became compliant. And as it turns out, this So as an industry, I think we're all evolving. One of our other partners that Darren and I share is a company called PCG Advisory, which led by Jeff Ramson, who has a great initiative, www.digitalsecurities.com. So for anybody who wants to be up to date, the ecosystem has now created that. We've also created www.digitalsecurities.consortium.io. So this will be all the trusted partners ecosystem globally that are going to follow a fully compliant way of doing an offering, from the issuance platform to the broker dealer to the transfer agent to the actual digital securities protocol that you may use for your company, to the marketing firm, IR firm, media, the video, all of those things involved, and of course transfer agents. As far as regulations, look, I'm very fortunate as an entrepreneur and that I have been able to bring people on board to a KoreConX that brings so much value and wisdom beyond my comprehension. And one of them, I'm sure Darren will agree, is Mr. David Weil. David Weil is the father of the Jobs Act in the United States. He is also the former vice chairman of NASDAQ. And he always reminds me, because you got to understand, every day I read the news, there's a new shiny light in front of me. And I'll never forget October 2018, KoreConX comes out and tells everybody, we have a fully compliant digital securities protocol that is going to help the broker dealers, transfer agents, ATS, bringing everybody together. And the shiny light says, nope, we already built that in the protocol. Ha, look at that. And the reason I call it a shiny light, because, you know, a shiny light always glares at you. And I had to speak with David. I said, you know, David, how fast could the regulators change the rules to remove all the current things that are already there today that took 5 years? How long do you think it would start? Because if they started today, you'd be lucky if it can be done in 5 years, lucky. But you're looking at more, depending on the state, the governments and all that, it could be 8 to 10 years. So what I'm saying, in my view, is that the current regulations that are in place today took over a decade. When you listen to David, he will tell you the journey that he took to remove one element, which Darren pointed out, 506C, general solicitation. That took 10 years to get us there. That sprung off everything on crowdfunding. So I'm a big advocate that the ecosystem is formulating. Companies like issuance.com, digital securities. We even have law firms like Robin Sosno and Simon Rebel who are rebranding themselves to digital securities lawyers, and many others are doing the same. And I think that's a positive thing, because we all believe education is the key. Because if we can educate the investors and retail and institution alike and everybody else and the ecosystem, the companies will eventually understand that this is the path I need to take, so they do it properly. And in the end, we all win, because we have a healthy private capital markets.
Yeah, look, I agree. I mean, just a quick thought. I think investor education is probably the most important aspect for this industry to grow. And on the regulatory side, I think there's no better country on this planet to raise capital in than the United States. I think most entrepreneurs take for granted the environment we have here. I think there is regulatory clarity. I think the ability to generally solicit, which obviously you just heard took a decade to get enacted, is incredible. I don't think there's ever been a better time to be an entrepreneur in this country. I think the existing securities exemptions that are available to entrepreneurs are very powerful and are being used today.
Okay, great. So I don't think we're going to have enough time to get to all these questions. We did have quite a few come in. So what I think we'll do here on my end is I'll get all these questions that came in answered, and we'll put up a blog post, and we'll email out everyone registered for the webinar and let them know where they can find all the answers to their questions, because unfortunately we don't have enough time here today. But I did want to just quickly mention before I let everyone go that our next webinar actually focuses on Regulation A+ issuers, so the due diligence, disclosure, compliance, everything needed to run a fully compliant issuance. So that's going to be on April 30th at same time, 11 a.m. Eastern Standard, and that will have Sarah Hanks, the CEO and founder of CrowdCheck, and Darren will be very welcome back as well on that webinar. So like I said, all the questions that came in, don't worry, we'll get them answered. I'll post a blog on the KoreConX blog, and I'll email out everyone and let them know when that it's ready and they can go and check their answers. If you have any questions that come up afterwards, don't hesitate to reach out to us. And obviously, a big thank you to Darren for joining us today and Oscar for jumping on the webinar today. I think that was great, guys. Any final points before we close it out?
I'm just jealous Darren gets to go on again. I don't get it. I mean, I really try to dress myself up. I shaved, but that's okay. No better person than Darren to be, for all of the people out there that may not know, and I hope I stand correct on this one, Darren, you were the first Reg A Plus deal that got done in the United States, correct?
Well, it wasn't me. It was Paul Elio and Elio Motors, and we were lucky to be a partner in the deal. I guess my closing remark is, if you're listening and you're thinking about going down this path, you have to recognize that there is risk, there is uncertainty, there's risk when you're a pioneer, and the way to mitigate your risk is to bring in the right partners, is to do your due diligence, partner with the right attorney, the right technology providers. I think Oscar and team have a great platform. That's how you mitigate risk when you're on the bleeding edge of capital markets, and never give up. Best entrepreneurs are extremely resilient and persistent, so keep going.
Perfect. Couldn't have said it best.
I think we're pretty much right bang on schedule, so that was great. So thank you again, Darren. Thank you again, Oscar. For everyone listening, we did record this. We'll let you know where you can watch the recording. And again, I'll let everyone know, just because we did have quite a few questions come in, so I'll let everyone know when we have all those answers up and ready. Hope you join us next time. Thanks so much.